again, a good afternoon, everyone. So myself, Dr. Rakesh Agrawal, Secretary General, Risk Management Association of India, and I'm also the editor of the monthly magazine Insurance Times and Banking Finance. So before today, as you all have joined, we have a session on construction and infrastructure project insurance. So before we start the session, I will just give a brief overview of our association. So many of you might already have joined our earlier webinars or maybe knowing us. So just for sake of people who have joined fresh, so I'll just give a short, brief overview of our association. So basically, Risk Management Association of India was founded in the year 1992. It's a global body dedicated to education, research, and development. So we deal almost with all fields of risk management, including insurance, banking, corporate. So the idea of this platform was to build a common platform for all risk professionals, insurers, bankers, so that people can come on this platform and exchange information, news, views, and matters of current interest, so that they can collaborate and we can help in capacity building of all the members. So our activities range from we do a lot of webinars every month. We do a number of webinars. Then we have a portal risk management rmaindia.org where we have a separate section for members. Then we conduct seminars and we also invite technical paper writing contests. Then we are into advisory services. Then we offer training programs for different companies and we offer training programs for senior management as well as middle and junior level management. So during the last few years, we did a lot of webinars on different subjects, and we keep on planning new webinars depending on the latest trend. So here a list of some partners. We have our partners in Nepal, Bangladesh, then Saudi, and we are planning to expand this further to other countries. In space of training, we have an online course, 30 hours online certificate course in risk management. So basically, this certificate course, we had enrollment from around 7 countries. So this course gives a broad overview of the insurance risk management principles and practices. So overall, we have been receiving very, very good feedback about this course, and we keep on constantly updating the course. So the delivery partner is our smartonlinecourse.co.in. So apart from risk management, we offer other courses also. For example, we have a course on credit risk management, then generative AI. Then we have few courses on general insurance, life insurance, motor insurance. We have few courses, and in coming months, we are planning to launch few more courses. It is just a view of our governing council members. We have people from academic and industry body. So we have people of lot of experience from the industry, and we have people from different segment. It would be from insurance, banking, corporate, and all. So here's a list of our some of the group organizations. So we have this Insurance Times, a monthly journal, then Banking Finance, again a monthly journal, published since last 38 years. So we have Sashi Publications, where we publish books related to insurance exams. Then we are into training. Now the training has shifted to smart online course. Then we have two portals, Bima Bazaar and Banking Finance. So basically, we had this portal, this Bima Bazaar portal was launched in the year maybe in 2001 around. So this portal currently is running, but we are relaunching this portal maybe around 10th of June in 2024. So what we have done, we have completely restructured this website and portal. So I'll just show you some of the content that you would be covering. Yeah. So basically, this would cover all the latest and daily news and information about insurance sector, interviews from stakeholders, So we are planning to cover interviews not only from top management, but different stakeholders. It may be underwriting, claims, and other specific, maybe actuarial and all. So it will include a discussion forum. It will have case studies, case laws. Case laws again would be a very interesting because we are covering case laws from over maybe over several years and several courts. Then we'll be having a repository of insurance times journal. Maybe we'll be covering the past issues of the journal. Consumer awareness articles feature. So it will be a very interesting thing. So I would request everyone who is interested in insurance sector to log into the portal post maybe 10th of June. So before we start, a brief about Mr. Jointer Roy. So Mr. Roy is a business leader with more than 3 decades of experience in reinsurance, risk, corporate legal, insurtech. So he started his career in non-life insurance companies and in around 14 years career, and he has held a semi-diplomatic assignment UNDP. Currently, Mr. Roy is working for Julius Legal Services as a managing partner, and he is engaged in several services and connected with a number of companies related to specialty lines. So he is into different specialized insurance. So I think this was all from my side. So I would then like to invite Mr. Roy to take the session further. So the format would be we would be starting the session, and once the session ends, we will be having a Q&A. So you can note down the question that you may be having, and at the end of the session, we will be taking up the questions. Thank you.
So, good evening, ladies and gentlemen, and all participants. Welcome to this show. And I understand that Saturday afternoon is very tough for all of you, those who are working in the office, coming back home, and those who are relaxing at home during your whole Saturday week off. Uh, but I think I must say a great thanks to Dr. Agarwal. As you all know, that Risk Management Association of India, and particularly under the stewardship of Dr. Agarwal, so they are championing a lot of innovative ideas. They have been engaging themselves for the last 2 decades or more than 2 decades with the insurance industry, various stakeholders, and they are in fact relentlessly they are trying to get new ideas. What are the best practices in the insurance industry? What are the challenges going ahead? And also the enormous opportunities that this insurance industry are posing to us. There will be a lot of new areas of activities in the coming decades, maybe starting from this year onwards. And they are very rightfully and very rightly they selected this topic, infrastructure insurance and the construction insurance, and how if you see the current developments taking place in India and how India is poised for further growth. They aspire to become one of the most developed nations by 2030 or by next 10 years time. And it is the Prime Minister's, our Honorable Prime Minister's vision and his team of experts working within the ministry. They want to pose India as one of the powerful, most powerful, not politically and in other ways, also economically, one of the strong nations who could create their own presence in the global map. So please allow me some time, just share the screen. And I think it's this one. Yes. One minute. Yeah, so before I start, I think all of you know that construction insurance, particularly infrastructure project insurance, and its impact in the insurance industry as a whole. So it is the industry, infrastructure industry and construction industry, the way they are growing in this Indian market. And before I start this presentation, I just show some of the figures we got from the uh, Invest India. See the current trend, infrastructure
Yeah,
development
Mr.
and economic growth in India.
Mr. Roy, you can start the slide so it will be easier to see.
Where it is?
Slide show in the center.
Uh, I'm not getting this slideshow where it is.
You see
One
in the
minute.
top menu, after four menu, you can see the slide show button.
Oh, just a minute.
Just on the top menu, besides animation slide show in the top. Yeah, yeah, in that same line.
Sorry?
You have to go back. Yeah, in the same line. Slide show in the middle.
I'm not getting that. I don't know what happened.
If you want, I can share the screen.
Yeah, please. I think some, I don't know what's Gupta again.
I think you can see now.
Yeah, it's there. But what is this?
Yeah.
No, no, no. Some problem is there.
You can start now.
Yeah, but it's not moving. I don't know what's the problem.
I will move. I will move.
Okay. Yeah, sorry for the goof off. Yeah, this is, you see the current economic growth in and the development. It is the currently is a 3.3%. No, no, this is the first slide. So it's 3.3% of the GDP is allocated this year from last year's thing. And transport target is the major area of growth, where it's a 2 lakh kilometer national highway network by 2025 or 2026. So expansion of airports to 220, operating 23 waterways by 2030. And now just let me go back to the earlier slides, please. Yeah. Yeah, I think I start from this one. This expansion of airports to 220. So the idea is that they want to connect all the tier C cities. There should be air connectivity and 23 waterways by 2030 and multimodal logistic parks. They want by 2035. And the most important thing is the budget allocation. If you see the current budget allocations in this financial year, it is INR 5 lakhs crore from 3.7 lakhs crore last year. Okay. Uh, yeah. Now, if you see the Bharat Mata Prajona Phase 1, that is almost 35,000 kilometers of national highways by 2028, they want to construct 22 new greenfield expressway. And Udhan scheme, there's one of the enhanced air connectivity to all regional airports. Budget allocation will be something around 1,250 crores. Railways, of course, there are the Mumbai Ahmedabad bullet trains and the Chenab bridge that is on the pipeline, and almost 61,000 kilometers of broad gauge network they have completed. And ports, of course, there's a major area of advancement. Indian ports, the TAT will be 0.9 days, and total port capacity will be from 2,600 MTPA to more than 10,000 by 2047. So that indicates, and it's almost a 5 trillion US dollar investment by the next 5 years. And so we know that the quantum of growth and the government of India's focus on the infrastructure developments. And see the figures, they're all very impressive with 2,388 billion US dollar at various stages of development of this project's worth coming into very short period of time. And the major area of urbanization, their focus that at least 40% people, Indian people, they reside in the urban and semi-urban areas by 2030. So it will be all helping a very significant growth to their GDP. And of course, I see the digital infrastructure, at least 56% of the new internet users by all the rural areas and semi-urban areas by 2025. Okay, so this indicates like how important this infrastructure industry is for us, for our development, and for actually taking us to the next powerful nations, group of powerful nations which are economically reliant and self-sufficient. So India is heading towards maybe in the next 5 to 10 years time. So with this perspective, we start this insurance program that is on the infrastructure and construction insurance. So project insurance is the area here. Basically, the line of what we call mostly linked to the projects. It's called erection non-risk policy, marine income erections, strategic erections. But most important are the CAR and CPM policies. They're linked together. And also sometimes the owners, they take the delay in startup insurance as a in consequence with this their CR and ER policies. And of course, we have a comprehensive project insurance. It is drafted by Munich Re. So these are the main focus areas of insurance in the project insurance. Yeah, the next slides. So we'll be discussing the project insurance as a part, and then there are certain annual policies which are also linked to this project insurance. Oh, shit. Sorry again, this thing's got again. Yeah, we have started this annual insurance. So annual insurance is nothing but some, contractors, plant and machinery, CPM insurance, machinery insurance policy, breakdown policy, MLOP policy, and civil engineering completed this. So these are part and parcel of your annual CAR or ER project insurance. So we come to project insurance. Project insurance, you see it is various construction of roads, bridges, tunnels, airport terminals, railway wagons, and all this infrastructure units. So then If you see that, if you go by this slides, so this is basically classification of engineering policies. We have one side is the CR and ER. This is linked to project, and with this is advanced loss of profit, machine loss of profit, and is linked to is called the BI insurance, business interruption. And also we have the annual policies like erection audits policy, MBD policy, CCR, construction plant and machinery, electrical equipment insurance. These are part of this policy that are taken to be with this in conjunction with your project insurance. Now we go back to this history and evolution of construction insurance. You see that if we just first CR policy, it was traced back to 1929. It was issued to cover the construction of the Lambeth Bridge in London. And thereafter, it is mid of 1930s when the German insurers they created their own local version of the CR policy. So you see their legacy of this thing. But the real boom in the construction industry started, especially after recovery of the Second World War II. World War II, when a lot of construction of rebuilding the country, rebuilding the nations, a lot of installations, activities took place, and there was a new initiative also from this Second World War after Second World War. Until such time, this there was no such dedicated focus for this type of insurance. It was all under the purview of the property underwriter, fire and other class of business. So then they started with the more complex construction techniques. Insurance companies, reinsurance companies, they started deploying and engaging the engineers and risk managers into their portfolio, and they created a separate department called CR underwriting. Now we can say that 1980s onwards, early 1980s, is a London engineering group in association of the British insurers. So they created a special focus, and they just wanted to create some code of best practices for managing their construction business, and they're all linked to their underwriting policies also. And this actually introduced a new area where a dedicated focus for construction underwriting, and they created some, different practices so that to be followed and to be complied while doing this underwriting of this insurance. So there has to be certain, what you call it, a disciplined area, implementation of a code of practice, so that they link to the underwriting and issuance of the policies. And thereafter, the 90s, all this D clauses, LEG clauses, they came into practice. It is basically managing the entire workmanship, material, and design series of the wordings. So that was came into practice. And you can say that now globally, of course, these are the most acceptable terms of insurance conditions. And Minutely, Swiss Re, all these pioneer reinsurance companies, they introduced a specific wording and the type and terms of coverage. So that are universally accepted around the globe, including the Indian markets and in the Asia Pacific region as well. Then we come to this project insurance. Project insurance, we see that usually there is various stakeholders in this project insurance. One is the owner or the principal who is actually going for this project, taking the project, and this project is handed over to a set of contractors, very specially capable contractors, subcontractors, designers, OEM suppliers. So all these people who are involved in this in delivering this project completion, so they have a stake in this thing and they can take the insurance. So usually all these policies are taken jointly, having with the principal and on the set of contractors and other vendors. And the scope of cover is basically these policies are all risks policy, all physical losses, all illicit losses, damages, destruction, including the hunting losses, everything is covered. Until unless there are certain named exclusions are there, so everything we deemed to be covered under this policy. And this policy, project policies, usually, that's linked to their entire completion of project. Usually, these projects are 5 years, 6 years, plus testing and other. So, ideally, all this erection insurance like CRER, they are multi-year policies, usually 60 months, 70 months. But for the in the Indian context, it is all the reinsurers, particularly GICD and the other and their counterparts, foreign reinsurance bodies in India. So they have their treaty restriction that they cannot issue policy for more than 84 months. So ideally they say that 60 months is the construction policy and 24 months is the extended maintenance policy or deferred liability policy. So they have a underwriting constraint, like they cannot issue policies more than that. So most of the practical cases, what is happened, like you take a policy of say 50 months, 60 months period, then if the project is delayed or project till next time, so then you can extend the policy for further months, for the year on paying the additional premium. So there also, as on date, there is a prescribed rating pattern. Like there is a formula, like they charge for first 3 months and then they rate for subsequent months. But going forward, we don't know what is going to happen because there's a recent circulars from IRDA that they say that now the all this policy wording, fixed policy wording, tariff version of the or this thing, and also the pricing which is in place currently in place, followed by all the insurance companies in India. So that will be withdrawn. And so now there will be a new various, of course, will come later one and see how these things can take place.
So, Mr. Roy, can you
So,
press F5? It
sorry,
will. Can you press F5?
yeah,
It will automatically convert into slideshow. F5.
yeah, it's doing.
Acha, okay, no, you can continue.
Yeah, sorry, actually, I don't know what's the problem with my laptop or something there because anyway, sorry, friends, let's I think just take focus on this. So the section one deals with the material damage. Like for any other this property policy, it covers all risks and it is basically exclusion driven and is basically fire and alert perils, along with all accidental damage during construction period, during the construction site, and any other thing like for falling off objects, defective workmanship, materials, lack of skill, negligence, malicious act of human error, everything is covered. And then we come the act of God perils. It's all earthquake, landslide, rock slides, subsidence, and the STFI perils, damage, storm. So these are all, you can say, NatCat perils, all covered under this thing. And there comes the collapse, collision, and impact. And we'll come in the later stage that you see that collapse is the major area where most of the, at least 80% losses take place in the industrial policies due to collapse, collision, and impact. And then, of course, the theft, burglary are also covered. So it is just when you see the scope of cover, you see is a location risk covered, handling risk, testing risk, human risk, and AOG perils, act of God. So it's a combination of all these things are there. So it is a very wider, most wider cover, covering all aspect of your what you call operational issues and the construction issues. Then we come to this. It is a section 2. Section 2 mainly deals with the third party liability risk, like all the legal liabilities to third parties, either it's a property damage or some personal injuries. But so it is, everything is there, and there are some named exclusions like bodily injury to employees, workmen, property belonging to the insured, accidental accidents arising due to vehicles licensed for road use, because you can claim under your motor policy, waterborne vehicles or aircraft, and any agreements made by the insured to pay some. So there may be some, you have some internal contractual obligations, so that will not be taken care of under this. Then it's coming, it's a very important thing, like how once you take your insurance, so how do you define the sum to be insured? So usually we say that contract price, duties, taxes, and everything together, put together. Plus, there are so many other expenses, like for example, items supplied by the principal. In our practical experience, we have seen some of the companies to just to avoid paying more premium, they don't declare those components. So they just take the project value with plus GST, taxes, etc. But there are so many other components which are also part to be insured properly. So we tell them that it has to be each and every items which will be part and parcel of your construction of your erection policies has to be declared and to be covered under this insurance. Then the materials, wages, supervision cost, everything. then maybe some consignment will be imported or some indigenous consignment. So that you have to also add into your total value. Then your overall erection cost, plus you have all permanent civil engineering works and all other related works. So, and we say when we go for this thing, any machinery and other items, it has to be your current replacement cost of a similar item. So these are the basic areas we must look into. So we now we just see how this immunity wording. So there is a very widely accepted, and it's accepted in the global market. So that shows how things are there. The first concept is basically they say it's a comprehensive and adequate protection against loss or damage in respect of the contract works, construction plant, equipment and machinery, as well as against any third party claims in respect of property damage or bodily injury arising in connection with the execution of a construction project. So this is very widely and drafted in such a way. So their idea is to cover each and everything which are material to the risk. And it's maybe say that it's an all risks cover and all hazards is covered, which is not specifically excluded. So there is a named exclusions that is there. And there are also some important, areas this they identify. They in fact mentioned in the policy that most important causes of losses indemnifiable under the SEER insurance are fire, lightning, explosions, then the flood, inundation, windstorm of any kind, earthquake, theft, burglary, bad workmanship, lack of skill, negligence. So each and every aspect, if you see once you go to a project site and see all the the envisaged losses or the risk you envisage, that is actually covered, and these are a well taken care of policy. Then you come to the next part. So, like there are some named exclusions, and the policy is very, very specific about the exclusions. They said, yes, if the losses are due to this named exclusions, as we mentioned in the document, it will not be covered. So, and these are all very common, the loss or damage due to war and war-like operations, then to nuclear reactions, nuclear radiation, to willful acts, willful negligence of the insured or any of his representative or any vendors working on it, consequential loss of any kind, description, including penalties, losses due to delay, lack of performance, loss of contract. So these are the standard solutions worldwide acceptable. And this cover this policy is also there. They also included all the specific exclusions and mentioned in the policy document, like wear and tear, loss or damage due to mechanical and electrical breakdown. So is it everything is well defined? Once you see any policy document with the minute wording, so it is a very set of things are all very clearly mentioned, so that there is no ambiguity between the insured and the insured. So then we see this one. Yeah, this is also another important part that when the cover attaches from the commencement of work, usually we say when the first consignment reaches the site, it cover starts, or you have to put any policy commencement date in the document. So that is there, and it is valid till your project is completed and handed over, including for your year policy. There's a testing period of 1 month to 3 months, and that each and every activities are done, and the project is deemed to be handed over. So is there, or if it is not, you can also extension policy can be extended on paying additional premium for is there. So here the important thing is that under insurance is also applicable here in this thing. So when you take the policy, you choose all these components which are important for your delivery of the projects. Each and every component must be covered, and all items which are very vulnerable to loss or linked to your project execution has to be taken care of, and also the value should be your current replacement cost, not your book value or depreciated value. So, and there is also some, removal of debris and other areas, other owner surrounding property that also needs to be covered. And another thing is that is a maintenance visit cover. It is policy is also extended, and also the extended maintenance cover. So even after the what is called the protection it is provided under the maintenance visit cover. This type of cover also include loss or damage occurring during the maintenance period, but caused during the construction period on the construction site. So we need to understand this maintenance period cover, that it's not each and anything is covered. So that we'll discuss in the subsequent slides. Now is a premium competition, though there is also an indication in that how the premium is calculated. And basically, what the mimicry underwriters they follow, there are certain prescribed guidelines. They said that conditions on an exposure of the site, that how is atmospheric and tectonic conditions such as the probability of windstorm, earthquake. If this site is very important for your construction site, if it is very flood prone or if it's earthquake prone, so the either they may even reject this insurance or may load the premium. So there is always, when we do the risk management part of this thing, so we suggest our clients to identify these areas where there's a free of all this NatCat perils. Then design features and building materials. So there are a lot of inputs on that. So what will be your design features? Then the construction techniques. Nowadays, of course, you have a lot of new initiative construction techniques, which are maybe this 10 years back, these were not there. Now, of course, with I was recently going through one study that on the artificial intelligence, there are a lot of AI enabled techniques and services are there in the insurance and the infrastructure industries, so that they say it is well taken care of their risk and managing the projects in a very safe and clear manner, safety and without violating the international thing, climates and other, because now there are a lot of compliances, your pollution hazards, other social and other economical things. So there are a lot of areas you have to think into considerations when a new project you are thinking of. It is not only the site of the construction, there are other lot of other socio-economic governance issues, and also the climate control and other compliances. So these are all to be taken into consideration. In fact, there's a lot of debate going on, particularly for the coal-based thermal power plants. So most of the reinsurers and underwriters, they are declining to take this risk maybe next year onwards. There's a 2025, they will not be underwriting any of the coal-based plant because of the pollution hazards, and there are a lot of compliances that requires to be we have to comply with a lot of environmental and other issues. So there'll be, and if you see the India and the South African and the other these Asian countries, the coal-based thermal power plants are one of the major area of the sustenance. The energy production is there, at least 80%, 85% energy is produced through the coal-based thermal power plants, particularly in the India and whole of India subcontinent, Asia subcontinent, Southeast Asia, even this Africa and Middle East also. So it will be a very challenging scenarios to the underwriters or the insurance companies if all the reinsurance companies they stop underwriting this coal-based power plants. So now there are a lot of safety factors considered in the construction time schedule and measures provided to ensure safe execution of the project. So all these things have a bearing on the insurance premium. Then, as I discussed earlier, like sum insured is very important when we estimated completely erected value, including all materials, services, supervision cost, freight, custom duties, and any other cost and other expenses which are to be incurred for the safe and a timely handing over of the projects are to be covered. And for all items, it has to be a new replacement value. Then normal period, erection work period is there, and testing period is usually 1 month to 3 months, depending on your type of thing. Like for example, all your erection policies for coal-based power plant or some other plant is usually 3 months testing period they take, because they have to their things to be maintained, like certain area of their what do you call efficiency level to be maintained. Then, of course, the AOG perils are there, and there are a lot of considerations they put on while selecting the particular site. And of course, the testing period. And testing cover is only meant for the air and other policies where your machineries are installed. You can bring the machinery from other locations, install it at the site, and then you deliver the services and the final thing. But there was no cover for the second-hand machinery. Yeah. So here, if you can make a difference, just we think what is CR and ER. CR basically it's a construction of civil works, and we say that there's actually thumb rule or some thing like if we're taking more than 50% value of the civil works, then it has to be a CR project. And here is essentially where your machineries are installed. Your machineries are there in different sites, different locations. You are bringing the machinery at the site and erecting this machinery for delivering it to the your end customers and covered and it essentially it needs a testing period, but here there's no testing period required, and there's a normal AOG perils, design defect, extension like third party liability, additional custom duty. These are all same because these are the components, common components for both this year and year. And here another important thing is that year policy, it can be, the design D5, like the highest thing other than the improvement of your thing, anything is covered. But which is not applicable in CR. CR is only up to D3 that you can go for, not even D4, but DV4 deals with submission and other related items. So that is there. Now, the important thing is that there's some special project risk. We call it the wet risk. Wet risk is basically involves works in water, like your tunnels, dams, canals, where this working through the water or under the water. And all these underwriters and the GI Council, they have categorized certain risk as below. They said is a specialized risk, and this risk they need a permission of their reinsurers and also their head of underwriting business. So basically, they identified that all works in water, dams, canals, hydropower projects, tunnels, irrigation systems, caverns, so that they are all to be covered under specialized risk. And you just cannot just accept the proposal. It has to be a lot of underwriting safeguards and due diligence. And this excess are normally all these normal policies. Here's a 5% claim amount subject to INR 50 lakhs and INR 150 lakhs. But when you go to a construction project, this is not applicable. There is a very different scenario now. So depending on the risk and the type of project, the excess and all the normal excess and there are different type of excess are there set by the underwriters. So we'll discuss it at the later stage. And there are certain add-on covers that is already there. Debris removal, third-party liability, owner surrounding property. I've been telling you this. There's very important areas. There escalation provision is there. Then you have to include this inclusion of express freight, overtime wages, air freight, additional custom duty, design defect cover. And another important part is the CPM, like construction plant and machinery. In most of the insurance companies and their reinsurers, there is a cap on that. You cannot declare each and every machines under your CR policy or ER policy. Usually they give a 5% of the total value or rupees 25 lakhs. But now, of course, this 25 lakhs has been, you can even negotiate to up to 1 CR. So you get a free cover up to 1 CR. But there are certain type of machines like tunnel boring machines. These are very expensive machines. So ranging from 150 crores to even 600 crores per machine. So these type of special machineries are not covered by GIC and any of the foreign reinsurance branches in India. So their treaty doesn't allow to cover of this type of thing. So you have to declare these machines and to be taken a separate policy under CPM, which will be in conjunction with your normal CRER policies. So there is most important thing. And others, there's all common limited and extended maintenance covered, depending on your what you call the liability and your what you call your the terms of agreement as per your LOA. So you can take that. And terrorism cover is mostly, it is a standalone terrorism cover. It is the current practice, like when the risk is 2050 crores and above. So mostly there are a lot of underwriters available in Indian market. So they offer a very competitive pricing for your standalone terrorism with or without this, what you call it, liability for any terrorism or any sabotage cover. So there are, a lot of customized cover is available now. Particularly, we know the Merkel and other Chaucer, they're the very renowned tourism market, and they're also operating in Indian subcontinent. So we can even choose depending on the requirement, and also at your construction site. If the site is not, located in not in a very, you can sometimes we say is a very prone to Naxalites areas and some other antisocial activities. So if it is not that, then you can even remove all those additional coverage, and you can take a simple this tourism cover with or without the sabotage and other activities. Yeah. So that is done. So next is that these are the common clauses attached to all engineering policies, 50 clauses, 72 hours clause, free automatic reinstatement clause, waiver of subrogation, and then the design defect clauses. That are very important that I'll be dealing with this separate chapter. Then you come to, so this is that we're starting talking about the owner surrendering property. So that is most important additional cover that you have to think of an input in your policy, that any what you call it loss or damage to property located on or very adjacent to the project site and belonging to or held in care. Many of the times, it is not your property. The machinery or some other equipments has come, which is under your custody. So you have to, which is under the control of the principal or the contractors. But then you have to also have a separate arrangement and declare this value so that in case of any loss or damage, it can be covered. So these are the standard exclusions applicable for all project and engineering insurances, like war and nuclear risk, as we know, not there. Design defect, bad workmanship, contractual liabilities, consequential losses, delay, wear and tear, opportunity loss, and the goodwill losses, etc. Loss occurred before taking policy, natural or slowly operating causes, and cessation of work, or total or partial. Now, I think we'll be discussing, not in this thing, there will be a very interesting area of where is project abandonment due to various reasons. Maybe it's your operation of any act of God peril, or any other political reasons and all this thing. So I think that needs a very specific sessions, and there are a lot of things to be discussed. So these are the basic area of exclusions that is common in all insurance policies. And there are also specific exclusions like faulty design, the policy access uh, to files, drawings, accounts, bills, currency. These are all very common to all the property insurance policies. And loss to vehicle license for general road use, because there are because that can be covered under a separate motor policy, which is already there. So we go to the next slides. He says that LAG tunnel work clause, because why I think I find it very important to discuss here, because now when we are seeing that a lot of tunnel works are coming, a lot of in fact, I personally work for two major tunnel construction projects where there is a lot of even some losses are also reported in this thing, and there is a the policy is designed in such a way that they defined each and every both the role of underwriter and the insured. Like they say that there are certain exclusions they already put in the clause, like all this policy will not cover any alterations in the construction method, unforeseen ground conditions and obstructions, improving or stabilizing ground conditions, and sealing against water ingress, dewatering, and the reasonably incurred following indemnifiable physical loss or damage, and overbreak or over excavation in excess of the design profile, and a refilling of the cavities resulting therein. So these clauses are very specifically, incorporated in the policy to avoid any further, what do you call it, misunderstanding at the time of claim. So it is very mentioned there. Then we see that there's very specifically that damage due to breakdown of the dewatering system, if such damage could have been avoided by the use of stability standby facilities, loss of bentonite suspension on any other media or substance which is used for as a ground conditioning support. So they have very specifically mentioned this. These are very technical terms, but it is mentioned there so that the project contractors and the operators they understand the implications of this and they take enough care of that. Abandonment of section of tunnel works that are not subject to indemnifiable physical loss or damage. and abandonment or recovery of tunnel boring machines. So then there comes, like, they put a limit on that. If in case of this type of losses, how the underwriter or the loss assessor will do that. They also said very specifically that in the event of indemnifiable physical loss or damage to the tunnel works during the period of insurance, the maximum amount payable under this section of the policy in respect of tunnel works shall be limited to expenses incurred to reinstate the insured property, but not in excess of the applicable monetary limit as specified in the policy. And where no monetary limit is specified, then the percentage limit shall apply. So there is a very specifically they mentioned their type of settlement of loss, and they said that the monetary limit shall be inclusive of all applicable cover extensions under this section of the policy. In the event that one uh, occurrence affects one occurrence affect two or more tunnel works elements, insurance will pay no more than one. That is the highest single limit that is applicable in these circumstances. Then we say there is a tunnel. They defined that what is a tunnel works, what are the things to be covered, what type of structures. It is very specifically mentioned here. The tunnels, caverns, shafts, and associated underground structures, howsoever constructed, and including the renovation of the existing underground structure. So these only they will be treated to be taken under the consideration for claims. So this definition shall not apply to non-structural elements like cladding, fit out, monitoring, contracts for electrical and mechanical fit out, or cable installation and building services and the like. So they have very specifically mentioned that what to be covered and what not to be covered under the alleged channel clauses. And they also said that percentage limit calculated in accordance with there's a formula they devised. They have said that immediate damage length multiplied by original per meter construction cost multiplied by percentage multiplier. So there is a formula that says, and in most of the cases, we've seen that most of the policies, if we currently what we have seen from GIC, they put this type of tunnel works of say 10,000, 8,000 plus crore of sum insured 5 years plus 2 years thing. We have seen that they put 110% as the percentage multiplier. And if there is no such percentage, then it has to be 100% of that. So there is also a very important, understanding of this insurance, and these are the things which has to be discussed before with this at the time of when they submit their prepare their project documents, and because before they submit for the tendering, so the operating all the contractors and all the subcontractors, all these people, because I remember last year I had this thing, opportunity to working with the company called NCC, Nagarjuna Construction Company. They are actually competing one of the canal projects in India, in Mumbai. So, and I was a consultant to them. So before that, we had a series of meetings with GIC and 2, 3 insurance companies, and we told them that see, these are the conditions which will be applicable in your policy. So your technical team, your project director, your finance director, everybody should know what is to be covered and what not to be covered. And accordingly, you have to plan for your risk management activities or your other activities. So it's in fact this particular company they are actually they'll be buying. They have not yet bought this. The two TBMs costing 625 crores. So one TBM is costing you 325 crores, and it has to be imported from Japan, and there are actually more than actually 100 specialist engineers, then other technicians. They'll be coming to install this machine. So it may be the next year, it will take another 1 year, more than 14, 15 months to procure it and make it, at the project site. And it will be taking at least 3 to 4 months time for enter installation of the machine. So see, and they were under the impression that their CR policy will take care of this thing. Then I had to, in fact, convince them that these are the machines we have to take separately, and you have to pay additional premium for your CTM policy because your CR policy will not take. And these are the machineries, very special machineries, and only very few underwriters they accept. And it has to be properly, underwritten by your reinsurance. If it is not vetted by reinsurance, no company can underwrite this business, this risk in India. So these are the areas where we need to convey to them. Then we come to this next slides. And they also said that is what is immediate damage length. That is also mentioned in the lectural clause. That is which is permanently physically lost or physically damaged. And this shall include section of tunnel works. This definition that are unaffected except for the presence of water or debris will not be covered. So they very specifically mentioned so that to avoid all sort of confrontations at the time of claim. So we go by this comes to design defect. This is also another very important areas of conditions, and but this is incorporated in this construction policies, project policies. So here is a DE1, D2, D2, D5. D1 is the outright rejection of all, each and every exclusions are there. There will be no defect things to be covered. D2 is extended defective condition exclusions. Only certain things will be covered. Then comes the D3, which is a limited defective condition exclusions. D4 is mostly dealing with your mechanical and electrical equipments, where something nut and bolts are not to be covered, but others covered. And D5 is the most, what do you call it, extensive thing that covers almost everything, other than the improvement of this any techniques and procedures. So that is also a very, eloquently discussed and also incorporate in the policy to understand. So we now go to this. Maybe we can take one example of D1 to D5. See, it is the supporting. If you see that picture, that is the supporting rod is defective actually. So because of this supporting this rod which is defective, the column falls, the roof falls, and the damages there in the floors. So it is the defective part is the supporting rod. So it is there. D1 it will not cover anything. Nothing is payable. So due to what they pay, resultant damage is payable. That is the floor damage, because floor is got damaged because of that defective, that rod, and because of that, the column falls and the roof also falls on the floor. So it will be paid. D3, what they pay is resultant damage is payable. That is the floor damage. So that is they'll pay, and D3 will pay you floor and roof properly, which relies on support of defective property. So they are payable because of this thing. Your roof also collapsed. So that is there. D4, what will pay defective part is the only exclusion, that is rod. So other than the rod is the floor, roof, and column, everything payable under D4. And D5, even rod is also payable. They said, okay, we cover the defective portion also, defective parts also. But any improvement cost to design of the rod is not payable. So, so this is a very simple example that you explains all this thing. So we go to the next slides is there. So the refund of premium. So here's also very important thing, like if your project, say you intended a project for say 60 months, and your project is completed before that, you can even apply for a refund, a pro rata refund of this thing. But there are certain conditions the insurance company put that there has to be no claim or claim should not exceeding 60%. And this original policy period is not exceeding the contract period. Say your contract period is fixed, say 60 months, and you have already taken extension of say another say 1 year. Then you say I want my project is completed, so I want refund. That will not be there. If it is original policy, contract policy is 60 months, and you complete this thing in say by 50th month, so you can be eligible for refund. And of course, if there is any other areas like your existence of the contract, then you can take what is the original bar chart that said there is a policy completion period. And the minimum period for which refund can be claimed shall be 3 months. So at least 3 months and above we have to claim for. So this provision is also there indeed. And because this is there to encourage the contractors and on the promoters like to early completion of the project, so that there is some sort of what do you call reward in the system, you can get some refund in the premium. Then there is also another facility of premium installment. Like usually these are the 5 years policy, at least 60 months policy. So once the policy is more than 13 months or more than 1 year, so there is a what do you call it, quarterly installment facility. Only thing is that the first installment should be at least 5% more than the other installments. And this thing will continue till your project is completed, or at least there's a 6 months before that you have to complete the final payment of premium. And yes, and installment amount 95% of premium numbers. So that is this these advantages are extended to the the insured. Then, of course, there is a maintenance period cover A and B, and extended maintenance. We cover both A and B. It is basically caused by the insured contractors in the course of operations carried out for the purpose of complying with the obligations under the maintenance provisions of the contract. And the second extending part is that occurring during the maintenance period, provided such loss or damage was occurred on the site during the erection period. So those losses can be traced and can be paid under this extended maintenance, or we can say deferred liability insurance. So we go to this. This is this ALOP. It is not a very common thing. Like only it is people take at the time of ER policy. You have to take. You can take this policy at first loss of profits. But nowadays we hardly see. I mean, the occurrences are much less compared to the earlier thing. So you can do that. And also the delay in startup that is there, particularly when your project is delayed for whatever reasons, particularly your maybe some of the supplies not reached or may not be possible to come, or there will be certain financial losses due to the delay to start the project. So all this type of thing, but you have to take this policy along with the material damage policy of CRER only. At time of it's a conjunction with your CRER policy. But this is also we hardly see now this DSO policies are, I mean, not a very I mean, it's a usual thing. Only very few people take when they have what do you call it, completion pressure or some other financial liabilities. Otherwise, they are not taking this policy at large. It's a basis of indemnity. So that is it is also mentioned that if you go for a advance loss of profit or DSU, so what will be your this basis of indemnity for principal and owner, because it is only applicable to principal owner. The contractors are not able to take the policy. So it's basically like any standard this business interruption policy. It is loss of gross profit, and you can also cover any loss minimizing expenses up to the cost they will be avoided due to delay in project commissioning and increase in cost of working, subject to, of course, limit of savings and profit. So this is a very standard calculation, and that can be also taken. Sometimes it is there like all your standard cost, owner of the project. Some you can also even add your financiers or bankers who are lending this thing. So that is also there. They have insured interest and they can take their any standard charges. That is basically debt services, principal and the interest amount, any fixed cost, plus net profit actually sustained due to the actual turnover falling short of the target turnover, which would have been achieved had the delay in project commissioning not occurred. So this is a very well defined, scope of cover, and also the what do you call it, your charges and what are the components of to be insured. That is all mentioned there. So these are the very common terminology of LOP. The annual, you see that we say annual gross profit, period of insurance, COD, that date of commencement is particularly applicable for your thermal power or any power plant project where you have to be COD is to be there. Indemnity period, time excess, turnover, annual turnover, and rate of gross profit. These are very common terminology in the insurance. Then we go the annual insurance. Like machinery breakdown is a very common. People take these policies that from it is not unforeseen and sudden physical damage to machinery from the following causes. So they also well defined, like whatever to be happened is mentioned, like if faulty material, design, construction, erection, vibration, so defective lubrication, loosening of parts, stress, failure of insulation, failure of operation safety, human failures like lack of skill, lack of knowledge, and more negligence. So it is all there. Then we go. machine breakdown is also there. It is, I mean, but currently we have seen that machine breakdown policies are more, attached to the your usual operational policies. People take this thing, and then we come to the annual policies. Of course, it is there, additional scope of cover and all this thing, express delivery, overtime, holiday rates, earning property and third party. So these are the you can take under your CR policies. Of course, there are certain named exclusions. Other than this, it is there. Then machine loss of profit also currently it is not in use. In only very few people they take it. Machinery loss of profit and also the and it is mostly with the erection or policies or income erection policies, but not CR policies. Then you go to this boiler and pressure plant also, but not required very frequently. So you can do this. But I think it's also not there, but I think this, yeah, the contractor plant and machinery, these are very commonly used and there are very frequent demands because in the Indian insurance, this there are a lot of machines they are not covered. So and also there's a limit under your CR policy. Lot like all your machineries are not to be covered under CR policy, inbuilt policy. So you have to arrange for a separate policy, and so it is mostly common because when a high value machineries or as I told you earlier, the TBM and some other this type of other machines meant for tunnel work and other thing, particularly the wet risk. There are a lot of high they call it box carton box type of thing machines. So these are not actually covered. So we have to take a separate contractors only is basically contractors plant and machinery CPM, and that you can cover under a separate arrangement. And here also the same rules applicable that you have to escalation clauses to be there. And here also you have to take the machinery sum insured as the current replacement cost with all other cost, auxiliary cost, and all these things included. Whatever your operating cost, your this you so because most of this very complicated machineries they need a series of expenses to be incurred at the time of erection at the time of installation, like the specialist engineers and some other technicians. So you have to account for all their service charges and everything to be covered as a part of this thing. So it's done. And of course, the additional cover is there, like express freight, overtime, repairs, clearance and removal of debris, surrounding property, and third-party liability. These are all we have discussed. It is there. And these are also very common exclusions. Uh, uh, it is applicable for all this engineering policies, are very common exclusions not covered. And then there are a lot of, currently we see a good demand of this civil engineering completed risk, CECR, particularly the roads, runways, bridges, tunnels, harbors, guide roads, and pipelines and reservoirs, etc. So all this contract, even of the completion of this thing, when this everything is completed, but they go on a annual policy, annual every year, they renew the policies and the certain agreed terms and conditions. So that is in RISE, and we see CECR, of course, as we discussed, there is also a huge scope of cover that, like any other engineering policies, they have operational part is that it covers all NatCat perils like fire, lightning, explosions, RSMD, the impact of any impact damage by vehicle or anything, storm, cyclone, any other subsidence, inundation, or volcanic war, landslide, earthquake, fire shock. So it is almost everything related to any property insurance, all risk insurance is covered here also. Then we see is some of the projects which is completed or under completion, dams and other thing. Then we come, this exclusions is also a normal exclusions, like whatever this, other than this RSMT, which is optional cover. And these are all, common exclusions applicable for all engineering policies. So we go to the next slides. It is midterm increase sum insured is allowed. You can even do that. And you have to pay the premium at the short period scale. And and also you can also even midterm decrease is also possible. If the sum insured decrease during the currency of the policy, short period scale update shall apply on the decrease sum insured. So these are some, special benefits given to the insureds to accommodate or to arrange their pricing and other thing. So we go to this. Now we just touch some, couple of slides on the reinsurance, because all this project insurance are directly linked to reinsurance, because mostly there are the 2,500 crores above this projects. So it is essentially a RI driven product. And most of the companies, they do not have that capacity to underwrite this thing in full. So they need to have some what they call capacity from the reinsurers and some other markets. So I just discuss a little bit on the reinsurance. So insurance, we know everybody that risk is basically transferring to reinsurer and a reinsurer. So in between there is a contract. So it is defined here. This is insured and insurer. There's the insurance contract, and insurer and reinsurer is called reinsurance contract. It's a very, just from a layman's point of view, nothing to be, it's a very simple, just one to think. And we see that so just like a a tutorial, a type of reinsurance contract is a treaty and facultative, as all of us know. And we go for that TT versus facultative. They are both advantage. Particularly, all these projects, they are actually mostly covered under facultative insurance because of their high value and high sum insured. So what usually people do, all these Indian insurers, they have their TT insurance. That TT insurance covering all their routine thing, all their whole years of business activities. Each line of business is covered under the different line of business, and they give a certain capacity. Say, for example, I get up to 1,000 crores, so my TT will cover me. But if you have to write a project of, say, 8,000 crore, then we have to calculate what we might approximate maximum loss, PML. So usually there are a lot of formulas used by Swiss Re and Munich Re, and earlier it is a TAC, Tariff Advisory Committee. So it's a very complicated formula. So I'm telling you, the thumb rule is that at least 30% of your project cost, they take it more or less 33%. But it is not a very accurate, I'm telling you. The Swiss Re mode of calculation, or even the TSC mode of calculation, is more accurate. But as a thumb rule thing, practice, we take 30 to 33% of your project value as my PML. So if it is, say, for example, 7,500 crores thing is my PML will be 2,500 crores, and I have a capacity to write 1,000 crores. So here also, I need additional capacity. This additional capacity can be obtained from my facultative reinsurance. So that is the simple, this thing. So I can arrange my capacity through that thing. So there is both some advantages of treaty insurance, like it is a less administrative work because everything is done in one go. Annually, for all my 12 months activity, everything is covered under one policy document for different line of business or different line of portfolio. So it helped me a lot of, now of course, as a, RI broker, we have seen that there are a lot of, customized reinsurance solutions where you can bundling all these things. So when earlier you have a different fire engineering, miscellaneous, motor, and LOB, different line of LOB cover. Now we can have a one basket, and that covers everything into under one basket, all line of business covered with some certain detention and other things we can have over and above retention that can be placed under a different surplus program. So there are a lot of things are there, but it is basically fixed terms and conditions. So all through the period you'll have a fixed terms and there will be no changes. And it is almost a very, what you call, a very static, not dynamic. And there are a lot of advantages also there, like the ease of reporting, accounting. Your premium will be accounted for at the end of your every quarter. So there is also provision of paying the premium at a later stage. And disadvantage is that it is not a flexible rating. So whatever you agreed at the time of opening this thing, initial period, that will continue. Commission income is also less, and no innovation or technical support because the GT underwriters, they seal this thing, sign this thing, and keep it. For 1 year. So there is no such a discussion on this thing. But now, if you see the facultative insurance, the advantage is there is a tailor-made solutions. Like I want to know this, like I want a cover of say 500 crores capacity and a particular project. So they will tell you what are the best possible rate and what are the technical support it is there. So they will provide you a very customized solutions and in just few minutes. But disadvantage is that each and every risk you have to treat it separately. Like TT is a one TT signed, so all your business for next 12 months is done. You are deemed to be covered for all your activities. But in the facultative insurance, each and every activity you have to get it endorsed by, you have to pay separately. So there are a lot of administrative work, accounting, and this reporting issues are there. And also for all facultative losses, there is a claim cooperation clause that we'll be discussing later. That the TT underwriter, not the fact underwriter, they put this clause so that at the time of claim, it has to be controlled through them, like including deputation of surveyors. So he cannot even commit, the direct insurer cannot make any commitment of this settlement until unless their TT, their reinsurers, approve it. So these are the some disadvantages thing. Then for reinsurance for project risk, yeah, that is most important. That the current governance or the current IRD regulation that says that each capacity based on your PML, as I discussed earlier. And now there is an obligatory TT session to GIC. That is 4% of the business of the risk. So if the risk is 1,000 crore, that I get 4%. It is almost obligatory and automatic capacity to GIC. I can set to GIC, and then based on my deductible and my net capacity. Say I tell you most of the company, it's depending on the small company, they have a capacity of 10 crores to like your topmost PSO companies, they have 1,000 to 1,100 crores. Because one of the large PSO insurance company, they have increased their capacity this year. So it is around 1,100 crores for all this project risk. They can write on their net. And of course, then this amount, which is their net capacity 1,100 crores plus 4% obligatory cession to GIC, and then the amount which is not covered, so that is actually FACAU. Then I can get this support through my facultative insurance. So this is a very simple understanding. And then for each and but each, that facultative thing, one thing is that for each and every project, if my capacity is required beyond my TT limit and capacity, to obtain the additional capacity for my project. That is for each and everything. So we go by this. Then comes, there are also certain IRD regulations that all these reinsurers will be underwriting this business. They has to be properly rated by international agencies like S&P, AM Best, Fitch, CRISIL, ICRA, and it has to be A or A minus rating, or at least triple B rating by AM Best. The current things are there, but for even for treaty insurance, there's some relaxation is there, but for all the fact placement, because fact is the instant one-to-one cases. So and there is no what you call legacy for this thing, but treaties are all linked to the last 10 years, 15 years, and it goes on this thing. So there may be some relaxation, but all your this thing, it is A or A minus by AM Best or equivalent international rating agency. And treaties are mostly by GIC, because GIC is a treaty leader for all the Indian insurers. And of course, now we have the couple of foreign reinsurance companies operating in India, Swiss Re, Munich Re, Scott Re, they are coming. So they are also writing and giving their support. And like, for example, as we discussed, like standalone terrorism cover, SAT cover, it is purely on fact terms and it is easily available now. There are a lot of players operating in India and giving this. But only the thing is that because of the catastrophe losses are going high, so there is a minimum nat cat rate. So sometimes we have seen that your primary rate is going high because of there is a minimum prescribed nat cat rate. So that I don't know what will happen after October, when they said that this pricing will be withdrawn, tariff ordering will be withdrawn. So when this minimum nat cat rate will be there or not. So this is the current trends. So we'll go by this. So these are the reinsurers currently operating in India. Other than the GIC is a national reinsurance company. Of course, the Swiss Re, Munich Re, Hanover Re, Score Re, ITID, Excel, Catlin, Lloyd's Syndicate, Allianz Commercial. So, but I think two more companies or three more companies are in the pipeline. So they may get their license very soon. So now I think there is a total around 11 to 12 active reinsurers, and they're all very well rated. They're all A minus or A plus rating of AM Best and SM S&P. So they are operating in India. So I'm showing you some minor regulations. Regulations, they said very clear, like there's an order of preference. Like any Indian business, any risk you have to offer to first GIC. GIC is the first right of refusal. If GIC doesn't take the risk or take a part of the risk, then only it can be offered to the FRBs, the listed FRBs, as I shown in the earlier slide. That is there. Even if some of the portion is remain, like they said, okay, they may not cover the full risk, then it will go to another set of things like your gift city. So there is another set of reinsurers working there. And then the last stage is that, because the regulation says very specific, like no Indian insurance company, no Indian insurer, they cannot offer any of the fact proposal or write any of the treaty proposals until and unless that all these procedures are allowed. But they are allowed only for facultative placements, not for annual treaties. You understand my point? First thing is that it is the GIC. GIC either retains the business in full or accept a portion. Then there is the FRBs like Swiss Re, Minifree, Scorri. You go to them and get, if these two layers are fully, fully absorb your risk, that's fine. If anything is left out, then you can go to the third layer of reinsurers operating in the gift city. So they have a certain thing. And at the fourth end, suppose for example, even after absorbing all this, it is not fully absorbed, then the remaining portion can be offered to the Indian insurance. So they can offer it. So like this, it will be your placement status. So this is the same like regulation said that what you have to do. There's a series of activities. And then I come to our last slides. They call understanding of mega risk. What is mega risk basically, and how we treat it? Because most of the project insurance is coming under mega risk. Because there is a lot of advantages in the underwriting of this thing, that all possible risk which you envisaged, like it is possible during at the time of construction, erection, then the testing and handing over till handing over. So the all risks are covered because there are a lot of research going on. What are the type mostly involved in delivering this project safe and safe fine. So these are all designed and already but documented for. Then it's a single document policy, one policy document covering so many areas: liability risks, your other extended liability risk, your property damage cover, everything is under one go. Then it is a cost effective than individual policies, because if you write individually, so you can take 10 policies. So instead of 10, you get one policy. And it is another advantage is that there's all Dex policy until unless there's some name description which is very much mentioned there. And there's a single highest deductible that is applicable for advantages is there. And it is a reinstatement value basis, all your coverage and sum insured to be decided. And it is reinsurance driven because the Indian companies, they don't have the full capacity to underwrite this business as a whole. So RI is a compulsory component here. Then they said there's a definition that said that any one location, it should be 2,500 crores, both PD, property damage and business interruption claims, business interruption, sum insured put together, and liability should be at least 100 crores. And advantage is that there's a flexibility of wording, add-ons, and it will be more so when we face the next phase, that when everything is withdrawn and we are put into the open market. Like I fix my own wording, I fix my own pricing, I fix my own terms. So now, as on date, everything is some sort of but regulated, not regulated, been guided. There's a guide rate or guide, or agreed policy wordings, because this agreement should be from both sides, insured, insurer, everybody. We come to a conclusion, yes, these are the most trusted. Like, for example, the Munich Re, Swiss Re wording, which are universally accepted. So, and it is also linked to your treaty and all other, wordings, policy wordings. So there is advantages there. And it is a tailor-made policy, which are fully reinsurance driven. Then, of course, the claims management, as I told you, that all your facultative placement, the reinsurers, they have a direct say on the claim settlement, right from the appointment of surveyor, reporting to the insurer surveyors, and visit to the loss site. So everything is controlled by them. So it is there, and then I just come to this end. So this is the end of my thing. And then I have this case study that I can show you one that that is called Anai Sleep, which have been drafted for a real time that's a project construction project a few months back, and based on that we actually negotiated with the Indian insurers, international insurers, and also the direct insurer. So I can show you that. So I think
I,
stop sharing. No.
yeah, you can stop. I think can we have questions because we are already running out of time. So should we take few
Yeah,
questions or should we show the last?
I think that we can show just maybe 2 3 minutes.
Okay. So you
Then I
can
can
just
take the questions.
yeah, you
Yeah,
can
yeah,
stop
yeah.
sharing and share that file again.
Yes. Yeah. Oh, Rakesh ji.
Should I show? Should I show it?
Yeah, can you show it? It is not
Yeah,
here. Actually.
yeah, I'm sharing.
Just I'll take just 2 3 minutes just to show them the the
Okay, no issue, no issue. I think it was a PDF file, no?
it is a PDF file. Yeah.
Yeah,
Yeah, specific fact risk fact arise need this one.
yeah,
Yeah. So this is actually a project site. Just I worked for a couple of months back. There is in Mumbai. There's a tunnel work of on 5 kilometers. So this is the actually I've not mentioned the name of the company and all this. So this is the facultative reinsurance sleeve for contractors. All this. Yeah. So when we design the slip and we approach the insurers, so this is you can say it is almost the same template used by all other insurance brokers and the companies. So first you name the name of the principal or insured, and then here we mention the name of the contractors. And here the idea is that you have to have all the names of the all contractors, subcontractors, suppliers, project managers, consulting engineers, because this type of complicated projects, there are so many consulting engineers, so they have a very specific a date, a specific role and functions. So everything is very widely mentioned. All the technical consultant, technical advisors, and others engaged to provide goods and services in connection with the performance of the contract, insured, and or any other interested parties, any other respective parent companies. So idea is that you once you issue a policy, you bring them all this put together, whoever the insurable interest or a function is to this contract. Then we see that it is a contractor's audit policy, and usually we say the minimum wordings and clauses that is actually acceptable to GIC and other international market. So we mentioned that, and then we mentioned the location of the project. It is in fact the twin channel construction along with the highway in India. So that we mentioned, and here we mentioned the entire. What is the scope of cover? We said it is design, construction, operation of twin tunnel, including box tunnel, curtain and cover, along with electrical, mechanical, and all associated works. And we usually we submit what do you call the a copy of the contracts. That contracts mention everything, so that insurance company they cannot tell no this is not covered, that is not covered. So everything is well mentioned and included. Then you see the section material damage, and that covers each and everything. Like we mentioned here, that project work, including but not limited to temporary works, everything, whatever the part of my activities, everything will be mentioned here, so that is each and every activities are well mentioned. Sometimes we attach a separate sheet, an annexure, where your all your line of functions, line of activities are to be mentioned. So idea is that you are not taking any risk for so that the certain things are not included. Is there? And there also you made what is this section 2? There is a third party liability with cross liability, construction period, and everything is mentioned. Like sum insured, we mentioned what are the amount to be covered with all this technical length of this thing. So each and every, and all the technical data are mentioned, like it is a overburden, minimum height, maximum height, the lining, RCC. So what are the technical inputs? And we submit a separate sheet of papers with all their technical, reports, soil testing reports, flood, this return of flood report. So there are so much of document, to be attached along with this proposal form to the insurance. And then we said that the project construction period is 60 months. And here the client they want extended maintenance period of 120 months. But then, of course, nobody could give this cover. They said we give only up to 24 months. So that is there. And here, if you see the deductibles, and see the deductibles are very high. This is what they said. Like for material damage, in case of material damage, act of God, tunneling losses, and others, they said it is 10% of the claim amount, subject to minimum 5.5 crores each and every loss, not from your other normal losses. It is quite higher, deductibles. And for all other claims, it is 5% and 1.25 crores. Design defect is 5 times of AOG excess. It means it is such a high, amount of this thing. And here they mentioned, we mentioned all this add-on covers. We want that. Then, yeah, then move it around. Then we mentioned what are the things we require, detailed things mentioned there. What are the add-on covers, extensions, and then we mentioned that what are the warranties and all these clauses to be there. So everything is mentioned, warranties and clauses. These are all mini warranty clauses and everything, conditions. Then it is there. So here the problem is, when you negotiated with GIC, so GIC started, because client wanted a full cover, like AOG and all this, they want a full cover. But the insurers, they put a loss limit. They said your option is that we give all AOG pedals, they put a 500 crores loss limit, any one loss, and 750 crores during the entire policy period. So now all these reinsurers, they are, because of that loss, when researching the losses, or maybe the NatCat activities are quite high in this Indian subcontinent. So these are the difficulty we are facing. So this way, then there are a lot of engagement, because each and for getting your rate and all these terms conditions, we had to submit a whole set of documents. It's almost 200 and 400 and 50 GB files. So that files you cannot even send. There are some. So it's okay. So that's all from my side. So now we can go back to this Q&A sessions.
Yeah. So thank you, Mr. Roy, for that interesting session. So if anybody has any questions, they can unmute and ask.
I think we overstayed the time, no?
No, no issue. So I think there's one question from Mr. Ahmed. What would be the cross liability regarding CAR policy?
Sorry.
Mr. Roy, if you can see the chat, what would be the cross liability regarding CAR policy?
CR policy. Yeah, cross liability thing is also there, because the policy, when you design that liability portion, so there is a cross liability, like when you are liable, when as a what you call it, as a contractor, you are doing some project, and doing that you can also some what you call it, some activity or accidents. So where there is then you are also liable for this thing. For example, I'm telling you, this is a very common in the Indian construction market. That is, we call it, there's a very technical term, like you are doing what you call it, a piling work, that VRWS vibration, but that's thing. So then doing that, you may even create a crack on the other side of some wall, adjacent wall, some other, that is not this thing. So here you incur some, life expenses, and then you are actually liable. So you have to pay for that. So this is coming here in this into this segment.
Yeah,
In
one
fact,
question
I
from
got a
Mr. Ayan.
question like
How to determine the testing time in CR projects?
testing time
Testing
is
time.
actually not there. Testing time is not applicable for CR project, because CR project is basically the construction thing. So testing time is it is there on the all the erection on these projects, where you have the commissioning of machine, and there you have a time to 1 to 3 months time. Like during this testing time, say for example, I'm giving a very simple example. Like you are constructing a power plant, power generation plant, coal-based power generation plant, where you have to produce at least 110 megawatts. You know, So that they during at the time of when the erection is completed, machine is installed, then you have a testing time of the 3 months. You take a 3 months or 1 month depending on your requirement. And during this period, you have to ensure that when you hand over the project to the supplier to the main users, they get a 110 megawatt power generation capacity. So then it is applicable. But here is a simple construction project. Suppose, for example, you construct a bridge or canal or highways. Once the project is completed, you just hand over. There is no such testing period. In fact,
One
I
question
have a
from
question. I don't know whether Mr. Balasubramaniam is the Chief Regional Manager of Oriental Insurance RO2 Mumbai. He sent me this thing. He has a question. Bala, are you there?
no, you
But
can
I
take up
have
the
seen
question,
Bala.
Ashu.
Yeah, so he said, I have a query with regard to dismantling of policy wordings of all tariff business. Do you think our market is ready for the challenge? Number one, what will be the challenges in front of the surveyors? Even with the tested and tried wordings, we were having a lot of legal and arbitration matters. What will be the status with the different wordings? So it's a very relevant and a very pertinent questions. In fact, I have also got a similar type questions from two other participants. I mean, I don't know whether not there because they text me and told me that they may not be the full, attend, but this is their question. It's the same questions. Yeah, Bala, thank you for raising these coins. Yeah, because like you, I'm also a little bit afraid, like what will be our preparedness? Because prior to this presentation, I've been interacting with all the 4, 5 major insurance companies, particularly all the PSU insurance companies, their GM projects and GM techno marketing, DGM techno marketing, and I asked this question like, when what are your preparedness? Like when your guide rate or that or tariff or whatever you say, the policy wordings, everything is withdrawn. Now all of you are competing in an open field. So, like for some of the companies, they said yes, we are preparing. We are actually in sync with the Munich Re, Swiss Re, and we are getting it. I mean, in fact, some of the private companies, their chief underwriter told me, like they are basically getting the ideas from the reinsurers. So my idea is that like it is not an easy thing. Like for example, you said from 1st of October, I as an insurance company, I have my own wording. I have my own pricing. I have my own terms condition. But that will be not if it is not in sync with your reinsurers. Say, for example, currently in the Indian market, we use that unitary wording. All your reinsurers, insurers, everyone, they use that. So from say 1st of October, I said, okay, boss, I have my one wording, and that is not in sync with the current my reinsurance program. So what will happen? There will be total chaos. Your reinsurers will not accept your terms, your wording, or your premium. Get my point? So it is most important thing that first you have to think your current wording, pricing, terms, condition, everything must be in sync with your current reinsurance arrangements. What your reinsurance program said, what are the policy wording they're using, what are the terms, conditions, and what are the pricing mechanism they adopt to. So if the three are not telling to each other or not, in sync with your current reinsurers, I think it is impossible. Number one. Number two, then if you say now currently, though there is a competition, but there is a common practice, like common code of what do you call all the risk and what do you call your policy wording, premiums and terms conditions, everything is same. So all the 2025 direct insurers, or even to some extent the reinsurers also like GICD, Munich Re, Swiss Re, they're also in sync with the current policy wordings and terms. So now from 1st October, if I start using my own wording, which is not in sync with my reinsurers, then you, as my opponent insurance company, you have your different wording, different terms. So that will be total chaos in the market. So first of all, we need to understand that what we're going to do, and secondly, all our the clients. If you see the top 10, your infrastructure clients like your Tata Powers or this the Abscons, NCC, J Kumar. So they are also they also understand like this is their current arrangement, current policy arrangement. There are the current policy terms, conditions, current wording, current pricing. So one fine morning, if they find that it's a totally different thing, like they are charging us a 2 times higher premium, or they are putting much more higher excess, their wordings, everything is same because they have been operating in this with this policy conditions in in front of them for last 10 years. You get my point? So it is also important that we have to also take them into confidence. Like thus because it is also a very tested model, as Balasubram rightly pointed out. This is going on for last couple of years. It is a quite tested module and practices in the current scenario, which is also in sync with your reinsurance arrangement. So, and it is also acceptable to most of to the contractors or the insureds. So if it is not possible for us to in one fine mining. I have my own wording, you have your own, Pratik ji has his own. So that is my belief is that is not possible. So I think Pratik ji can tell us what will be your take in this scenario.
Sir, you are on mute. You can unmute. I'll just checking. Yeah, please see.
Yeah, thank you.
Yeah.
First of all, absolutely interesting and you know heavily involved session that you had, sir. Thank you very much for it. The question that you're having a discussion and what Mr. Bala Subramanian also said is a very pertinent one, keeping in mind the fact that the Indian insurance industry may not be ready to accept such a thing coming in right now. Having said that, I personally feel that we are the most evolving insurance industry in the entire world. And keeping in mind the fact that we have ensured that whatever best is available anywhere, whether it is the Swiss Re wordings, the Munich Re, the Lloyd's wording, whatever it is, we have assimilated the same into our own uh, sort of Indianized the thing, so from that perspective, it could be a rough start, but I'm slightly optimistic about it. Maybe it'll take some time to go forward and yeah. But the fact remains that this is a cause of concern not only to the PSUs but also to the private sector. Actually, the clients are not very mature to sorry to accept this as such.
Yeah.
Having said that, sir, when you were having a discussion about the various other parameters relating to the project insurance and the other policies, you talked about the reinsurance support. You also talked about the IRDA guidelines, sir. Could you also throw some light on uh, the role of the surety bonds, so as to say, sir? Do you
Yeah,
think
yeah, yeah.
do you think that they have made any difference in the industry in the last 13, 14 months or so?
In
Yeah,
fact,
yeah.
today
In fact,
we
I
were
was
having a discussion with Mr. Roy for having a
yes,
separate
yes,
session
yes,
on
yes.
surety bond
Yeah,
also.
yeah, yeah. Maybe next month I'll bring in another session. So whatever my understanding is that the surety bond has been accepted by NHAI. So
Yes,
they made it compulsory for all their partner contractors.
correct.
And they said that this NHAI, in fact, they have been pushing also because there are some government assistance. In fact, I have been to with my IRD a few months back. So there is a high part government committee, and they're also actually empowering IRDA to engage various level of shareholders engagement, so that this surety bond is made one of the what do you call it, replacement of bank guarantee.
Correct.
Because now
Correct.
there are a couple of companies are issuing, particularly the New India is one of the stalwart, and another two, three private companies like Bajaj Alliance and ICICI Lombard.
Bajaj was the
But
first
they are
one to
not
promote it.
not in a big way. So here advantage is that because now there are a lot of also changes in between. Like the surety bond document can also be taken as a collateral. Like
Exactly.
like the way the bank and financial institutes they
Exactly.
have the recovery rights of their defaulters. So the insurance company will have a similar right. I think there will be some legislation coming very soon, or some activities coming very soon. And what they have done, so they have also made the pricing very competitive. In fact, I am also advising one of the company in Delhi called Surety 7. So they are actually bringing in some of the advantages, like they have already earmarked some of the reinsurance company, Vietnamese reinsurance company. They got the FRN done in India,
Wow.
and they are very much willing to support the Indian insurance.
Fantastic.
So in fact, my role is to go to the insurance companies, make a presentation, and take this thing, and it will be very very advantageous for the all these contractors, like instead of having a bank guarantee, so because when you buy a bank guarantee, you may be paying simply less, but
Correct.
your money is already stocked there. It is already attached, or you give some collateral and something. But surety
Sir,
bond, the advantage is that it's the document, it provides you all this thing. And it
sir,
will be slightly expensive, not like if you pay 0.3 as a charges on the value is your bank guarantee charges, you may pay 10-15%, even 20% more. But
correct, sir.
that
Then in
gives,
that
that
case,
is not freezing your money,
no, sir.
so that is.
In that case, right now, I'm telling you that I'm already looking forward to your session on surety bond,
Yes,
and
yes, yes,
this is
yes,
just
yes.
a confirmation, and I'm sure Dr. Rakesh Agarwal will confirm it so that we can book our dates and venue at that time, sir.
Yeah. So
Definitely.
that will be another area, that will be a new area, new opportunities. Because as I told in my beginning of my session, like the current, if you see the current scenarios, there are a lot of new opportunities coming.
Correct,
One is
absolutely.
the surety bond. Another
Absolutely.
is there is a lot of the merger and acquisitions. So there's a new set of insurance thing coming, and of course the DNO and credit, the credit insurance. So if you put together all this into one basket, maybe there'll be one specialty risk of thing along with cyber. So this will open up another area of revenue generations, both for
True, sir.
the insurance company, insurance broker, and all. And this will also help because the way the infrastructure companies are growing, you see that 5 trillion investment coming in the next 5 years. So surety bond, actually, what I understand that that is 30% of your project value. It can be your insured value. So any
Absolutely.
project, you can just imagine that is if it's a 5 trillion investment coming in the year, so 30% of 5 trillion will be your amount, and you calculate the premium. So it's a huge area untapped. So
Yes, sir.
one development, opens up a locket of another few, So that will be also, and now there are a lot of companies they are also eyeing for the India market, particularly I also interacting with two London markets. So they are very much with me to support the Indian insurers if they come very aggressively with surety bonds, performance bond, and
True,
others.
sir. True.
So bond markets, they think that India will be a very crucial for them because of the investment size, the way the Indian infrastructure grew and the future developments. So I think this is the area, Pratik, we can work for, and
Absolutely, sir.
Rakesh ji is always there to promote this type
Absolutely.
of activities. So we
So
have
there was
a
a
next
question
session
from
there.
Nasreen. If you can unmute and ask if you are there.
Please, hello.
Yeah.
Yeah,
Hello. Thank you, Mr. Roy, for your nice presentation.
my pleasure.
Actually, I I would like to talk about tunnel insurance. In Bangladesh, actually, tunnel insurance is totally new in Bangladesh, and honestly speaking, uh, we are totally blank about tunnel insurance. But we have
Tunnel,
opportunities.
tunnel
Tunnel
insurance.
insurance.
Yes,
Yeah,
yes, yes. Uh,
we are totally blank about tunnel insurance. So I would like to ask you some questions regarding tunnel
please.
insurance.
Yeah.
Uh, Actually, what are the risks of working in tunnel? First one, and second one is what are the tunnel safety rules? And third one is what is the uh, minimum length of actually tunnel, and why are tunnels safe?
Okay. So I first answer your first question. So because I think you have witnessed very recently, 2-3 months back, that on 41 workers they got stranded walking in a tunnel in near Uttarakhand. So that describes the risk. So how they are almost 41 days, almost 40 days they are confined within the caves, and it has actually happened while doing some construction job. So one portion of the thing there is also some faulty design, whatever maybe the thing it is, because it is not yet identified the cause of losses. So in fact, as a insurance practitioner, I wanted to get some details. So what I came to know, like while they are doing the piling job of this within the inside the tunnel, so but they actually, there's a prescribed model is that once you enter into a tunnel, you construct a tunnel job, a tunnel portion, then there's the stipulation of 10 meters, like you 10 meters you construct a concrete roof, a concrete ceiling. So and then you go on doing this thing. So there may be some, because nobody knows exactly, because of that debris and some other associated risk. So the engineers and surveyors, they even could not even enter and do a proper survey job. So that is the loss is not yet known. So you know that risk is very much there, because the moment you work inside the tunnel, so there are chances of collapsing, and it is very much there. You can say, in fact, there is a mimicry study that shows that almost all this project and the construction risks, more than 80% losses are due to collapse and some impact and within this thing, and that is mostly within the construction period. So that is number one. And number two, tunnel actually is very popular mode of accessing the the roads, because where there may be some easy way. The tunnels, once they do the tunnels under the this thing beneath this your surface level, so they save a lot of time and also, because in doing any project on road, it's also very difficult. Like for example, all metro rails. Like in Calcutta, we have the metro rails. It is 80% is the tunnel work. It is the under the beneath the ground level.
Yeah.
Even sometimes I know we have another portion. It is also underwater. The Ganges River that is there. You see the metro this metro lane other parts also. It is a both combination of both the tunnel and also the surface thing. And what is the third question? Like, what are the safety?
Yeah. My third
So
question
safety,
is
there are a lot of this international group, like particularly the London Engineering Group. So they have a very specific instruction and compliance thing for tunnel works. So that is there. So they have a very specialist engineers. They are expert in tunnel and excavation work, and they have a very prescribed mode of activities for the contractors. They say each and every inch how we will proceed. So there is a very prescribed mechanism and prescribed booklet, and also they have their prescribed thing for the insurance. As I discussed 2-3 slides, like in case of any tunnel damage, what will be your percentage of multiplier, and how this thing will be worked out, and what are the components will not get under your claim, what you get. So everything is very well defined. In fact, what you can do, if you have any such proposal, you can send it to us. So we have a team of experts who can, in fact, I'm doing one just completed on tunnel projects in Mumbai. It's a 5 kilometer stretch, 4,800 kilometers,
sure.
4.8 kilometer stretch of a thing. So, and we have in India, we have a lot of experts there into these tunnel jobs, engineers and the risk engineers and other specialists. So I can even connect them with you, with your team, or I can even give you. I have also a lot of prescribed study material from Mimicry, Suikri, and LEG. So they've shared with us what are the best safeguards for both for the contractors, for the principal, and also the end users. That is possible.
Thank
We'll
you.
do that.
Fine. Okay. Anyone has any other question, or should we wrap it up?
Yes, sir, I have a question.
Yeah, please.
In maritime direction policy, is the policy access of commissioning, testing, and erection period separately written?
Sorry, I can't follow you. Can you just what is the
In
question, ma'am?
maritime
Main
erection
income.
policy, maritime erection policy access of commissioning period, testing period, and erection period separately written or one? Only for
No, this we are from which country? You are from India?
No, I'm from Bangladesh.
Bangladesh. Okay, all the Indian policy, there is a very specific mentioning of this thing. Like all the main income erection policy, if the testing period is there, we specify this thing. And depending on your type of erection and type of industry, so there is also very prescribed period of this thing testing. So everything is mentioned there in the policy schedule.
Okay.
So any other questions? So I think we are coming to the close of the session, and if anybody has any specific questions, they can also email to us. So we'll try to get it replied by Mr. Roy. And
you can share my email ID or WhatsApp number.
Yeah.
So we can actually, if you have any very specific questions relating to project safety and the implementation of safety rules, all this thing. So we have a team of experts working with us. So we can give you a very professionally managed response, not just a layman's view. Just
and just to announce, in next month, we just finalized the session on design thinking. So Mr. Pratik would be taking it. So very soon would be sharing the details of the session. So I think
Yeah.
that would be a very interesting
Yes,
session
yes,
on
yes.
design thinking. So
Design,
Mr.
design.
Pratik ji, if you would like to just tell in a few words what can we look for the session?
Sir, I did not think that this was the correct forum for you to announce. More so because one of the stalwarts is sitting right in front of me, and suddenly I'm
No,
feeling
I'm not
scared of this
stalwart.
fact, sir.
No,
But
you
sir,
are not less than a stalwart, sir.
sir,
No, I'm not a stalwart, Pratik ji.
Sir, the idea is that the significance of design thinking has been acknowledged in almost all spheres of our life, particularly the management areas, However, we have been implementing certain bits and pieces of design thinking process, even in insurance industry. We have not collated it, or we have not talked about it systematically and specifically saying that this is how the design thinking moves in the insurance area. I propose to do that in the session which I was talking to Dr. Rakesh Agarwal. And this is going to be an interesting session because this is something new that has come to the insurance industry. Keeping in mind the fact that design thinking per se, we have been doing a lot of changes there. We have been doing a lot of improvements. Disruptions, of course, are there. But design thinking as a unit will be there for the first time, sir.
So what is it?
And
Design?
Design
design thinking.
Design thinking, yeah. Particularly, so he'll be taking care of the insurance industry, like.
Absolutely,
yes.
absolutely.
Yes,
What is its applicability in insurance sector?
Yes. Yeah, that is very interesting, and a lot of because insurance industry, there are a lot of new openings are there. So it all depending on your top management, how they have to seize this opportunity, and what mindset they have for the for the changes. Because the what do you call it, the climate change is another area, and in fact, I'm very keen to work, Pratikji, with this climate change, with through some good organization. They have the AI enabled the systems. Number one, and number two is that to prevent that that cat losses. So India is a huge area market for. There's a gap in the cat cover. So there may be some customized program which we can in fact design for this.
Now that you mention it, let me also confess this and take it to the public domain that July, the Asia Insurance Review based out of Singapore is having 20th NatCat conference at Manila. And I've been invited as a speaker there to talk about the specific case studies of natural calamities and leading to climate change. I was lucky to have discussed a similar situation 2 years back at Singapore when they had invited me. So I'm lucky that they have invited me this time, and July
that'll be great
to have a discussion.
Congratulations in advance.
Thank you, sir.
So,
okay, please share with us your thing, like
absolutely, sir.
your
Absolutely,
discussions
I'll share.
presentations.
So I'd like to thank all the participants.
I have a request. Thank you, Mr. Roy, for your nice presentation. Actually, my request is it's not my only my request. Many of our attendees are looking for soft copies of your nice presentation slides.
Yeah, that we will see in what way it can be done. But usually
because
we
there is
circulate
actually, I don't know
YouTube
this
YouTube
mail
version
will
of the
support
same.
because there's a huge
So you will be
thing.
receiving a link. So from there you can access the full lecture again.
Yeah. But Istak bhai, if you have any queries, you can drop an email to me.
Yeah, sure. And if you have any queries, you can drop an email. And thanks a lot for all participants for attending. And even past, I think that now the time is 6 o'clock, 6 past 4, and still we have 33 participants. So thank you everyone for joining the session, and please keep on visiting our website for new sessions. So we keep on organizing this innovative sort of, keep on selecting these innovative topics. So thanks everyone. Thank Mr. Roy, thank Pratik ji, and every member who have attended. So we'll see you soon.
Thank you.
Thank you.
Thank you.